So I'm walking with my wife this morning and I asked her, what kind of dog am I? And she said, you're a watchdog, because this is the Issues Watch podcast. I told her that was a bad opening. Hello, and welcome to the Issues Watch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm the partner in charge of accounting and auditing at Sobel & Company. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are my own and not necessarily those of NJCPA or Sobel Co. Okay, not a lot of heavy activity again. I mean, you know, it's the summer, depending upon when you're watching or listening to this, but it is recording during the summer, and it's not a lot of activity, so who knows what's going to happen in the fall. But what happened recently, a bill came out that extended the enforcement action on PPP loan forgiveness audits and EIDL. So what's important to these, you're wondering, what does this have to do with accounting? So if you remember, if your company got PPP, you had some disclosure about the PPP loan. You may have gotten forgiveness. If you did get forgiveness, great. If not, then you probably have the loan on the books still. But if you got forgiveness, some people figured they're going to count for it under IAS 20 or under the FASB method. And if they got forgiveness, they said, okay, we don't have to disclose anymore because we got forgiveness. We disclosed we got forgiveness. However, a lot of accountants feel, and we discussed this at the A&A interest group, a lot of the accountants feel that there's still some disclosure required because up until recently, there was a 6-year window that they could go back and audit these loans. And this new enforcement didn't say audit necessarily, but it said enforcement action. So this is a contingent liability that unfortunately for you, your company, or your clients, if they have PPP and they received forgiveness, you probably should still have some disclosure regarding a potential contingent liability. Now, I wouldn't go very descriptive as to the old loan and what they got and everything. I would just put out there that there's a contingent liability for a loan PPP forgiven and the amount. Okay? If you want to talk to me about it, I'd be happy to talk more about it. An exposure draft came out. Now, we don't spend a lot of time on exposure drafts, but I found this pretty interesting. It's very point specific. We happen to have them in our office, these type of clients. So I guess that's why I find it interesting. Exposure draft EITF 21-A, accounting for investments in tax credit structures using proportional amortization method. What the heck is that? Well, in 2014, ASU 2014-1 came out, investments for equity method and joint ventures, accounting for investments in qualified affordable housing projects. So I know a lot of you out there saying, doesn't apply to me, doesn't apply to me. But what's important is there are a lot of companies where you have people in industry, or members that are in industry, or practitioners that are servicing these type of clients, us, so I guess that's why it's important, had this. So please know that this has been out there for a while. That pronouncement, 2014-1, provided 5 criteria that an investment tax credit structure must meet in order to apply this proportional method, amortization proportional method. Well, this exposure draft that's coming out is supposedly going to make it easier to do that amortization of the costs. So if you do have clients in this area, or if you work for a company or organization that is in this area, I recommend that you go look back at 2014-1 and then check out and just watch this exposure draft, because I thought it was very interesting what's out there. Okay, 8:42. What's 8:42? Let me check out the time. Coincidentally, probably about 8:42. That's not what I'm talking about, though. 8:42 is a reference, the codification reference to the new lease accounting. And the big question I have for you, are you ready? It is effective because remember it was delayed, for all intents and purposes, it's effective for calendar years 2022. It was for fiscal years beginning after December 15, 21, which means calendar years 2022. Okay? If you have not started thinking about it, you're way behind. We have a lot of clients that we have to work with in this. If they have GAAP financial statements, we're behind with this because the clients have been sleeping at the wheel. We've been asking them about this since February, March of this year. We've been asking them about it for the past couple of years, but particularly February, March during the audits, we were saying we need to get up on this, we need to get up on this, we need to get up on this. And finally, we have clients starting to work with us and give us their leases. We're helping them do the accounting for it. Some particular things I want to mention to you, and there's a lot more in this 842, but a couple of different things I want to mention to you. Related party leases. Frank Boudelet and I talk about this. If you have a related party relationship, but there is no legal binding arrangement for a lease, 842 does not apply. The Center for Plain English came out and talked about this. I didn't know if I agree with it. It's form over substance. Anyway, these are my comments, not the society's. Very interesting thing that we really can't figure out is a consolidating schedules. We do consolidated financial statements, related party leases involved, blah, 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 blah. This would be eliminated 842 in consolidation. But if you have consolidating financial statements, there's a big discussion of do you have to adopt it down at the individual company level. I'm of the opinion that you do. I'm not doing it because I'm trying to make companies do more work and an exercise in mathematics, but each company is supposed to stand alone on a GAAP basis. That's the reason they have push-down accounting. But I brought it up at the interest group level, and even there, people are like, there's no clear answer on it. Center for Plain English, nor the FASB have come out with anything on this. So it's a big one, and I recommend you start looking into this and thinking about it. Okay, AICPA came out with SAS 148. It's an amendment to AU, which is the Auditing Codification 935 and Compliance Audit. It amends SAS 117. Now, if you handle compliance audits, now we do some compliance in our audits in our office with nonprofits or other types of organizations, I recommend you look into this. Now, the reason this really came out was it was to update AUC 935, which is the compliance audit section, to address two recent SASs that also came out. SAS 143, accounting and auditing for estimates and related disclosure, and SAS 145, understanding entities' environment and assessing risk of material misstatement. Risk of material misstatement is still a very big area as it relates to AICPA and particularly peer review. I don't have enough time to go through a whole story with you of a peer review I went through that's been hanging out for a long time, but it is still a big focus of theirs. So I just sat through a risk assessment seminar by the AICPA, and practitioners still just don't have a full handle on it. Okay, let's go through three other quick areas. PCAOB, where's Frank? He talked about this last episode. If you didn't see last episode, go check it out. The PCAOB has come to an agreement with Chinese authorities. What the heck does that mean? If you saw last episode, the Chinese authorities have restricted the PCAOB from going and looking at Chinese, Hong Kong accounting firms' work papers and access to the partners, etc. And that the SEC and the PCAOB said, well, what SEC said, if you do continue this, we're going to delist the companies. So finally, they came to an agreement. A partial quote from the PCAOB chair said, PCAOB has signed a statement of protocol with China Securities Regulatory Commission and Ministry of Finance, the first step towards opening the access to the PCAOB to inspect and investigate completely registered public accounting firms in mainland China and Hong Kong. It's really big. We've been going through a lot here in the United States with PCAOB examinations. They serve a very big purpose. I'm going to leave my comments at that. But this is important that they're finally potentially getting access to inspecting the firms. Okay, SEC, this is just a quick one. Pay versus performance. I found this very interesting, especially for those that are in industry and working for public companies. A rule was adopted about the relationship between public companies' executive compensation and financial performance. Okay, you have to, there's disclosure requirement, and I'm not talking disclosure within the financial statements necessarily. It could be in the document, you know, the 10K, the itself, or the registration statement. Disclosure about the total stockholder return, very interesting. And the big one I saw was relationship between executive compensation, paid, and performance measures. Comparison between what was paid and the performance measures, and you should be listing 3 to 7 most important performance measures. I was like, wow, that's really, really interesting about that. So anyway, if you do work for a public company, I mentioned look into that. Last one I'll mention is R&D. R&D, the taxes, there's some tax changes as it relates to the accounting for R&D expenses. I know Nicole DeRosa is sitting there saying, who are you to talk about taxes? Stop it. This is the A&A Issues Watch podcast. Well, taxes is saying now you have to capitalize the expenses and then amortize them over 5 years. Wow, am I super summarizing that? But that's what it's kind of saying. Now, the old FASB, I think it was FASB 2, came out and said R&D expenses are expenses as incurred. Well, I have already had clients call me saying, if I have to capitalize them for tax, can I capitalize them for GAAP? So my question and concern is, what's going to happen to the GAAP accounting? I haven't heard anything, but I'm just going to keep an eye out and watch to see if FASB is going to change anything with this and see if the IRS or the government is going to lead FASB in accounting into a certain way. This could lead to book tax differences on the deferred charges, the expenses, and of course as to the tax credits that are out there. So those are the big areas. And isn't it surprising? I didn't mention one particular thing today. Did you notice?
ESG?
No, I didn't want to mention it. But since she mentioned ESG, there was a recent podcast by Sean Stein-Smith and I think the Center for Audit Quality as it relates to ESG, and they talked about that a lot. So if you didn't see that podcast or listen to that podcast, I recommend you go check it out. Sean is a great speaker and really, really smart. He actually scares me how smart he is. Okay, went a little longer today, so in closing, I'd like to remind you about some upcoming NJCPA events. On September 19th, there's a full-day webinar on assessing the risk of fraud in financial statement audit. Remember fraud risk assessments? On September 20th, there's a full-day webinar on how to avoid deficiencies in your peer review. And then there's 3 in-person A&A updates in September. The PCAOB chapter is hosting a 4-hour event on September 20th, which I think 2 hours is actually Leases. Go to it if you don't know it, please. The Bergen chapter is hosting a 4-hour event on September 22nd. And the Essex chapter is hosting a 4-hour event on September 23rd. This is like a buffet. You have to be able to get to one of them. Register for these events and more at njcpa.org/events. And be sure to join the NJCPA Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening. Boom!